Alright, the next agenda on the list is terms used in Forex trading. Every profession or occupation in the world has words related to it. These are the prominent related words that are used in Forex trading, be it stock, commodities, and some others, even currency pairs and synthetics as it can be. We have the following terms that are used. So it is very good of a trader to know or have the knowledge of these terms that are used so that you'll be able to know how to go about your trading life. The first on the list is spread. What does it mean, spread? Spread is usually referred to as the difference between the bid. Bid means buying price, and the ask. Ask means selling price. Brokers will pocket some of that difference as a way of profiting from the trades that they help execute on the MT4 or MT5 platforms. The more liquid and stable a currency pair is, the less of a spread there will be. Highly volatile pairs with less liquidity will have wider spreads as it is. So, spread trading can also refer to a strategy in which you simultaneously place similar long and short trades. This allows you to take a slightly bearish or bullish position that limits both your losses and potential upsides, that is buying option. That is what is meant by spread. And the next one is base currency. What does it mean, base currency? You need to know or have idea of what it is. The base currency is the first currency listed in a currency pair, such as USD Euro or Euro USD, where the US dollar is the base currency. But in the case of the one I have as an example here, Euro USD, Euro there is going to be the base currency, where United States dollar USD as second option there is called the quotes or counter currency. So if you are long, you expect the base currency to rise in terms of the quotes or against counter currency. And if you are short, you expect the opposite. So these are the terms that are used in Forex trading. Now, the next one is scalping. What does it mean, scalping? We need to have the knowledge of those things when it comes to trading. And whoever fails to know these terms is only joking or playing with his money. Scalping in Forex refers to the shortest trading time frame. It is a strategy that can be used in any market, whether Forex, stocks, or futures. Scalpers are those people that scalp. They exit a trade almost immediately after the trade becomes profitable. When it becomes profit, then they exit the trade. This typically only takes a matter of minutes or even seconds after the order is placed. Once they see it turns blue and they are satisfied with the little lot, they quit or exit the trade. Now, the next one is what is called broker. A Forex broker works as an intermediary between you as a trader and the interbank system. If you don't know what interbank is, here is the meaning. The term interbank refers to networks of banks that trade with each other. Typically, a forex broker will offer you a price from the banks where they have lines of credit and access to forex liquidity. Many forex brokers use multiple banks for pricing, and they will offer you the best one available. And these are the things you need to know about brokers. Forex brokers give access to foreign exchange trading and leverage to trade with. Before you start trading Forex, make sure you educate yourself and verify that your broker is reputable with good name. The next one I have here is what is called leverage. The lever in financial leverage is simply debt or borrowed money. This means you use other people's money to allow you control a larger investments on your account than you could have on your own. Of course, you must pay them interest for the use of their money. So this is what is called leverage in trading Forex. The next one is margin. Margin is the initial capital that a trader needs to put up in order to open a position. Margin also gives a trader the opportunity to open a larger position size. So when the margin is low, you won't be able to open any position again, and then you may be warned by the broker when you are exceeding the normal margin, when it's getting too low. Even many at times, they quit or exit some trades for you in order to save your money. The next one I have here is bid and ask. These are also two major words or terms that are used in trading. The bid price is the price a trader is willing to sell a currency pair, while the ask price is the price a trader is willing to buy a currency pair. So these prices are displayed on the left hand side of MetaTrader 4 MT4 in the market watch session. And the difference between the bid and the ask price is known as the spread. Now the last part of it on this particular page is long and short. When a trader goes long on a currency pair, the first part of the pair is bought. Let's say we have Euro USD, as you can see from the screen. So when a trader goes long, it means Euro is bought. That is what it means. And USD is sold. This means that you expect the price to rise, that is, in the case of a Euro USD, and buying the Euro against the dollar means you are expecting the price of Euro to rise. The other one is going short. This means selling one half of a currency pair in hopes that the price will decrease. These are other two terms that are used in the trading. Let's continue to see a few more. We have what is called pip. Pip is the movement, precisely smallest movement, reflected in an exchange rate on a currency pair. The pip is the fourth decimal on a price quote for a currency pair. It is used to measure value. An instance of this can be seen on the page. We have Australian dollar against US dollar. Let's say the quote for these two is 0.6876. That is the price quote for the two of them, the pair. Now, when it moves to, or let me say from 0.6876 to 0.6877, it means it has moved slightly, and this slight movement makes you or enables you to acquire more of the US dollar. That is what it simply means, which means you can place another order the more the pip is moving in your favor. That is what it means. So from 76 to 77 means pip. That is what is called pip, and that is 1 pip. The next one is lot size. A lot in forex trading is the size of trade or position that you will open. One lot in standard forex on a currency pair is the equivalent of 100,000 units of the base currency of the pair. So, if we look at Euro USD, this means that opening a trade in USD will mean the trade size is $100,000, Euro being the base currency. That is what this means. And also, one standard pip is worth $10. This means a 10 pip in incremental movements in the market movement in a buy position, a buy trade. This will represent $100 gain. Since we say a pip in one standard pip is equals to or is equivalent to $10, that is going to be, when we have the pip, the movement, incremental movement in the pip to be 10, it means we are having $100 gain already. I hope this is clear. And the last one there is bullish and bearish. These pair are also very prominent in the trading forex. Bullish market sentiment gives a view of the performance of a particular market or the stock market overall. When market sentiment is bullish, this means that the price is going up, that is buying, uptrend. And when market sentiment is bearish, this means that the price is going down, selling. Now, the simple illustration is like when bulls get angry, the animal bull, when they get angry, they toss things in the air with their horn. They toss it in the air. That is what it means, bullish. And when bears are provoked, so angry, they get on their hind legs, the front legs, and tear things down. That is knocking it against the ground. This means prices decrease. So these are the prominent terms that we have in trading. You can go ahead to search for more as it can be. So thank you for watching. I want you to press the button to subscribe, bring more people, share the link to the video and the channel. When I have more people on this platform, I'll be very, very glad to give more fruitful videos that will be beneficial to you, my dear listeners. Thank you very much and remain safe.